All right, let's jump right into this explainer with a bit of a mystery. Picture this. You've got a room with 10 friends. They're all exactly 30 years old. They live in the exact same neighborhood, work at the exact same company, and here's the real kicker, they all earn the exact same salary. I mean, from the outside looking in, their lives are a complete copy-paste of each other. But fast forward just 5 years, and the picture changes dramatically. 5 years later, out of those 10 people, only one of them has completely paid off their car loans. They've got an investment portfolio that's growing every single month, and they carry absolutely zero of that typical heavy middle-class stress. But the other 9? They're terrified as the 25th of the month rolls around. They're literally checking their bank balances with half-closed eyes, just totally panicked that the funds are drying up. So, how does this happen? The income was the same, the city was the same, the opportunities were completely identical. It wasn't luck, it wasn't a jackpot, and no, there were no rich relatives handing out surprise inheritance checks. It all comes down to a fundamental difference in habits and mindset. So to figure out exactly how that one friend broke away from the pack, we're going to walk through 6 crucial chapters today. We'll start with the middle class trap, then income versus wealth, the real math of money, debt, your real scoreboard, and finally, the biggest investment.
Let's start with Chapter 1, the middle class trap, how to escape the silent killer of wealth.
You see, this trap is exactly why so many folks are incredibly stressed no matter how hard they work or how many promotions they land. Those 9 friends who are struggling, they fell victim to something called lifestyle inflation, and it is a silent killer. Here's how it goes. The second their income goes up, they instantly upgrade their lifestyle. Boom, bigger house. Boom, fancier car. Eating out more often. The result? Sure, they're earning more, but their expenses went up by the exact same amount. They are literally running on a treadmill, exhausting themselves but staying in the exact same place. Smart wealth builders, on the other hand, absolutely refuse to upgrade their lifestyle until their assets are generating enough money to cover those new expenses effortlessly.
Moving on to Chapter 2, income versus wealth, why a high salary absolutely doesn't mean you're rich. Look, society completely conditions us to spend our whole lives trying to boost our income. We treat a high salary like it's the ultimate finish line, but earning a lot of money doesn't actually mean you're rich. Think of your finances like a bathtub. Your salary, that's the tap pouring water in. Your expenses, that's the drain letting the water out. Those 9 stressed friends are entirely focused on cranking that tap open wider and wider, just working harder and harder to earn more. But they are completely ignoring the massive open drain at the bottom. It doesn't matter how much water you pour in, right? The tub is never going to fill up. If you earn a fortune but spend a fortune, you're just a highly productive beggar. You're running around all day but keeping nothing. The top 1% focus on plugging that drain so they can build a deep, lasting reservoir of assets.
So how do they actually plug that drain? It's all about conscious spending. I mean, you've probably seen truly wealthy people driving older cars or just completely skipping flashy luxury brands. Society might call them cheap, but honestly, they are incredibly strategic. They mercilessly cut their spending on useless show-off items. You know, like buying a new phone just because the camera lens is shifted 1 millimeter to the left. But they will spend like kings on things that actually bring value. They'll happily drop money on a high-quality mattress, a really good ergonomic chair, learning resources, and their health. Why? Because a great night's sleep and sharp skills actually multiply their productivity. They ruthlessly cut liabilities so they can grow their assets.
All right, Chapter 3, the real math of money. Let's look at the actual systems and numbers behind that top 1%.
The financially free person doesn't just work hard. They understand the underlying math of wealth creation, and they build systems to do the heavy lifting for them. So first, we've got to talk about passive income. Now, I know social media has totally hijacked this term to mean like flashy cars and a fake beach lifestyle, but at its core, it is just a mathematical principle. It's decoupling your time from your earnings. If you only earn money when you're physically clocking in, your income is permanently capped. There are only 24 hours in a day, right? The 1% builds systems. They put in the effort once, or they invest their capital once, and that system just keeps generating returns over and over, completely independent of their daily schedule.
And when it comes to building those systems through investments, the wealthy follow a very specific rulebook. You've probably heard the famous quote, rule number 1, never lose money. Rule number 2, never forget rule number 1. The average person looks at an investment and immediately asks, hey, how much can I make? But a smart investor looks at that exact same opportunity and asks, how much could I lose? They completely avoid get-rich-quick schemes, not because they lack ambition, no way. It's because they prioritize keeping their capital safe above literally everything else.
Because here is the brutal math behind losing money. Let's say you lose 50% of your investment. You don't just need a 50% gain to get back to normal. You need a 100% gain just to break even. And that is exactly why the wealthy do not gamble. They don't take wild, uncalculated risks. They play a slow, super calculated game of probability because they know exactly how mathematically punishing a big loss really is.
So instead of gambling, they rely on what we can call an invisible calculator that's just constantly running in the back of their minds. They know compounding isn't magic. It's just pure math. When they hold a single dollar today, they don't just see a dollar. They see what that dollar is going to become in 10, 20, or 30 years. So skipping a frivolous purchase today, that isn't about restricting yourself. It's literally about buying your own future freedom. They know for a fact that patience, combined with time, is the ultimate multiplier.
Which brings us to Chapter 4, debt. Is it poison or is it medicine? Let's see how the rich use leverage differently.
So, is debt a poison that ruins lives or a medicine that cures financial stagnation? Well, the truth is, it depends entirely on how it's prescribed. Those 9 stressed friends, they're using bad debt. They swipe high-interest credit cards to consume stuff today that they can't actually afford, and they're just slowly bleeding out their future wealth to make the banks richer. But our financially free friend, they use good debt. They use borrowed money as leverage. Think business loans or financing an asset that actually pays them more income than the cost of the loan itself. They are literally using other people's money to multiply their own wealth. It's a total game changer.
Chapter 5, your real scoreboard.
measuring what actually matters.
If you want to win this game, you've got to look at the right numbers. Asking someone, hey, how much do you make, is entirely the wrong question. The only metric that actually matters is your net worth. And it's so simple. Just calculate everything you own, your assets, and subtract everything you owe, your liabilities. A massive salary is just cash flow. It's a total illusion of wealth if your debts are equally massive. I mean, you can earn hundreds of thousands a year and still be financially fragile. The top 1%, they don't obsess over their paycheck. They track their net worth religiously every single month because it's the only true indicator of their real financial health.
And to protect that scoreboard, they have to put on blinders. The world is constantly screaming at us with these act now offers and limited time opportunities. But smart wealth builders, they just ignore the noise. They have absolutely zero fear of missing out. No FOMO whatsoever. They know that if someone is rushing you to make a financial decision, something is definitely wrong. True wealth building is often slow, honestly a bit boring, and beautifully sustainable.
And finally, Chapter 6, the biggest investment, the crash-proof asset you already own.
Before they drop a single dime in the stock market, before they invest in real estate, the 1% make the absolute most critical investment of all, themselves. Look, markets are going to crash, businesses will inevitably fail, money comes and goes. But your earning power, your adaptability, your skills, your network, those are entirely crash-proof. If you have the ability to constantly learn, upgrade your mindset, and make better decisions, you could lose everything today and still bounce back every single time. That resilient capability, that is true security. So, we've covered the habits that separate the financially free from the perpetually stressed. But as this explainer's source material so powerfully points out, the real roadblock to wealth isn't a lack of information, it's a lack of action. Having all this knowledge floating around in your head changes absolutely nothing unless it changes what you actually do. So I'll leave you with this ultimate question. Will you actually change your behavior tomorrow, start plugging that drain, and build real systems? Or will you lie to yourself, keep chasing the illusion of a paycheck, and stay exactly where you are? The choice is entirely up to you.